Well, I mean, in general, we believe that oil prices remain range-bound on WTI basis between 50 and 70, which is a fundamental statement.
Which would suggest to me straight away, that you do not believe that geopolitics are going to influence, because if you did, then we would be talking about a price potentially north of $70.
There's always a risk of spiking oil prices. You know, we do fundamental analysis. Supply and demand suggests that oil prices should not go much higher above that range. Of course, you know, short-term spikes are always possible.
You are not an equity analyst. I'm at pains to suggest that as well. But is a higher oil price on the back of geopolitical concerns, which is what we've seen, you know, $5 roughly put on top of this price, is it good for the oil companies or is it bad for the oil companies, i.e. good because it's a higher underlying price for their product, or bad because it induces extra volatility into a key region for these companies?
Well, I mean, short term, we have seen that yesterday, the days before that, you know, share prices can go up. If oil prices go up, there's a clear correlation.
Saudi Aramco.
Well, that's a different story. But in general, you know, higher uncertainty is not good in the long run, of course.
Sure. Okay, Neil.
Sven, I'd be interested. The market seems very relaxed to some extent about this geopolitical tension because there's this perception of tremendous supply coming through and maybe a concern about maybe weaker than expected demand. Do you share that market consensus, or do you think the market is actually quite complacent about the ability to deliver the supply in 2020?
No, we share that sentiment. We believe that there is plenty of supply out there. The US is growing its production. Norway probably reaches a new peak production this year. Equinor's Johan Sverdrup field is ramping up as a big story. So there is no shortage of supply.
Even though we're seeing difficulties in Brazil, Mexico and many parts of Africa, I just wonder whether people are missing the fact that getting it out of the ground is proving harder, and even US shale, given Jeff's comments about credit, the US shale, actually the year-over-year growth could be actually very disappointing in the next year or so.
Well, I mean, you know, it's a slightly different story that for a lot of E&P companies, access to the capital market seems to get more difficult. But overall, supply, there's plenty of. You know, there is a reason why OPEC continues to discuss cutting production.
And I'm interested when one thinks strategically about this, you know, ultimately most strategic commodity, because it does make the world go round. We're seeing a lot of concern now around ESG investing and constraining investment into coal and increasingly into the oil industry. How do you think that factors into the availability of capital to actually keep the world going round on maybe in this decade? Is that something you're beginning to think about?
It's an increasingly important story, of course. When we speak to investors, they seem to be increasingly worried longer term about the implications of the energy transition. And you know, equity valuations overall of the energy sector are relatively low, and arguably it includes a view of rising uncertainty around the energy transition.
I love that phrase, capex discipline. There's something kind of Victorian and schoolmarmish about the sound of it, but it has major implications for the way the oil services sector performs over the rest of this year and into next year. And it just seems that as you watch the share prices deteriorate through 2019, there was little coming into year end that would suggest a turnaround for this year. All we've got on the table at the moment is this spike from Iran. Do you see any reason why companies will begin to relax those budgets? Because at some point, surely they have to reinvest in plant machinery and harder to get out wells.
Our view is that the oil majors, the large E&P companies, will not increase their capital budgets a lot. It has to do with a much increased efficiency. Those companies do pretty much the same today that they did 5 years ago with much reduced you know, budgets. A short-term spike in oil prices will not cause the likes of BP and Shell to raise their capital budgets. That's unlikely.
Do we need to take these companies at their word and stop calling them oil companies or oil and gas companies and start calling them gas and oil companies and energy companies? Because I noticed that the prism that I started off this conversation and that has been carried on from all of us is that these are oil companies. They are at pains to try and say that they are no longer oil companies.
I think there's some truth to that. We have seen, in particular, the European majors moving towards increasing their investments into low-carbon businesses in general. They are slowly, but they are moving to become really energy companies.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.